There is a lot of debate that's going on regarding the Financial Resolution and Deposit Insurance Bill 2017. There is also a kind of a fear-mongering that's going around, where specifically on the clause 55, which says that banks can use depositors' money if they go bust. And we have here with us Govardhana Rangan, banking editor, Economic Times, who's going to sort of break some myths and also shed some clarity on, is the fear mongering justified, or are we panicking for no reason? Thank you very much, Govi, for being here and kind of helping us out to break this whole discussion that's going around. How much is the fear justified that banks will use up our money if they go bust?
It's absolutely unjustified. If you look at the history of Indian banking over the last so many decades, we haven't had any instance of any commercial bank going bust where the depositors lost money. So to that extent, this is mere fear-mongering, and the bill actually, if at all anything, it aims to make the entire banking system and the resolution process a lot more stronger than what the current law provides for.
Right, and we see that the FRDI bill is still under discussion. How far is it from actually becoming a law?
It can become a law, and one of the reasons that they have drafted the bill and it is with the parliamentary panel is that the government is pretty serious about making it a law. But the fact is that what the bill and the final law, there can be plenty of changes and amendments and rules that would ensure that the depositors concerned are taken care of. So the bill that is as in the draft stage need not necessarily be the act without changes. There can be a lot of changes. There is scope to amend a lot of stuff.
Right. Now, coming back to the clause 55, as you pointed out that banks have never gone bust in India in the last 70 years, but that doesn't mean they wouldn't. I mean, let's assume that we sort of are faced with a situation where a bank goes bust. At that time, do you think still it's justified for the banks to sort of dip into the depositors' money to bail themselves out? I think that's probably what the issue seems to be here.
It's not a question of being fair or unfair. The thing is that it depends on, if you look at the kind of provisions that they have, there is a protection for the insured depositors first. As of today, up to 1 lakh of deposits are insured. But the bill provides for the government to project, or rather prescribe, what should be the amount of deposits that are insured. It can be 10 lakh, it can be 20 lakhs, it can be 50 lakhs. So to that extent, whatever the government says will be protected, right? So to that extent, if the government comes up with tomorrow, say that 25 lakhs of depositors' money is protected under the insurance scheme, then you don't need to really worry about that, because if you look at the number of people who have more than 25 lakhs of deposits in the bank are very, very few. But a lot of corporates, they may have a deposit, but do they need that insurance? No, they don't need that kind of an insurance. So the government can prescribe how much needs to be insured. So that has not been decided yet. So as the parliament members discuss this bill, so those kinds of classes can be introduced and then give a fair amount of protection for the common man.
Right. How do you see this bill compared to other countries? I mean, have other countries sort of like implemented something like this, and has it worked for them?
No, the thing is that again, this entire clause of this bail-in is a fallout of the 2008 the Lehman Brothers crisis, right? The thing is that if you look at it, even a capitalist society, a thoroughbred capitalist society like the US had to step in and bail out all the banks. Even there, the Lehman Brothers went bust, but the issue is that they did not allow depositors to lose money, right? So they came up with the 800 billion TARP package and then ensured that the banks don't go bust. So exactly to avoid, that was a taxpayers' money that was used to bail out. So that's when they came up with this bail-in clause, where the banks have to come up with the instruments and design of products where they would have enough cushion when they get into a crisis, that those things really bail them out. Those creditors first, the unsecured creditors and those who subscribe for preference capital, they bail in. That gets converted into equity first, and not the depositors lose money. So that is why this entire bail-in came in. So to that extent, this is a new concept that has come in, and you haven't had many countries which have actually put this into use.
So it's a first time for a lot of people or a lot of countries.
Yeah, it's a kind of a follow to the 2008 credit crisis. So before that, it is not gone. Even in India, that Resolution Corporation, that idea came after the FSLRC, the Justice Sri Krishna Commission report. So to that extent, that it's a completely new one. This is a baby of the credit crisis, which is yet to be tested.
Right. Now, let's kind of take it like much more micro level. If today there is a depositor who is watching this video of ours, what should he or she be worried about his or her money being used at time of crisis? Is there something that you would like to break down for them in few more sentences?
Just don't worry, you'll get your money back.
Okay, all of them?
As of today, yes.
Right. Okay, thank you very much, Govi, for joining us. I really hope that our viewers also have got some clarity on the big debate that's going on FRDI bill. Thank you so much.